Welcome to the Week in Italian Startup, where we discuss the latest highlights happening in the Italian tech and investment ecosystem. All right, welcome everyone to a special session of the Week in Italian Startup with me and Niccolò. Today is Tommaso Migliore, CEO and founder of MDOTM. Welcome, Tommaso.
Hi everyone, thanks for having me.
Ciao Tommaso, welcome.
Ciao.
All right, so we have a very juicy session today. Today we're going to talk about AI and banking and how exactly it's been evolving. And then we're going to focus on Tommaso's project, MDOTM, and see exactly how it has evolved during the years up until today, where he's been the protagonist of a lot of interesting, I would say, activities with different banks. And we're very curious to see how exactly the banking sector is moving toward AI. What is the feel? How is it seeing all the movements from an insider perspective? So without further ado, I would maybe Tommaso, if you want to introduce yourself really quick, just with a little bit of background, and then we can jump on the conversation.
Yeah, absolutely. So I'm Tommaso Migliore. I'm the CEO and co-founder of MDOTM. It's a fintech company that we founded myself together with my co-founder in London at the end of 2015. My background is econometrics and finance, and I joined forces with this long-term friend of mine, Federico Mazzorini, who's a physicist. And by combining two different elements, finance and physics, we created a business with one purpose only, which is to really put all our efforts into applying the scientific method as more as you can in investing. Now, artificial intelligence just happened to be the best technology to do so. So that's why we put all our efforts into it. And today we're a team of 50 people between London and Milan. And we work in a B2B with a B2B business model solely with the institutional investor to support them in their investment process at different level. I'll go into details later, I guess.
Awesome. So let's take a quick step back and maybe start from an overview, a broader overview about AI and asset management in general, and what is the quick history of time in a few words, in a sense. So I'm curious, what's your perception? What happened 10 years ago? Why it was not possible? Why today is a special moment for this kind of field?
So, I mean, really AI has been around for a long time in many fields, as well as investing. It's always, fascinating to think about why today, why now. I always get back to, I don't know if because I'm Italian, I go back to Leonardo da Vinci. I always remember that Leonardo was theorizing flight 500 years before we actually were able to fly for the first time. Why? Because of two things. First was an overall understanding on how an airplane is supposed to be structured, right? So the theory was there, but in Leonardo's flying machine, most of them were not really able to fly. Second, technology. There was not any way until the Wright brothers to put enough power in such a small place and light enough. So the weight to power ratio was too low. And so these two things together made flight a concept more than a reality. So artificial intelligence in investing and in general in let's say decision making has been around for many years. It's been theorized, actually, the first neural network way before computers were even existed. The problem was that similarly to Leonardo and flight, both the technology was not there, so we really had no chance to really leverage the power of computing. And the other thing was the theory, right? So yes, there were expert systems that were called back then, but we didn't have really a good understanding of where it was a good area to really apply and how to actually do it. So these two things combined, and so this is a good moment to be in the sector.
Fantastic. I love the analogy. Yeah. So are we at the Wright brother phase? Are we past that? Where are we with AI? Bringing on the analogy.
Yeah. So bringing on the analogy, I actually say this all the time, which is every complex technology at the very beginning is developed and used by the same people. Let's go back to the Wright brothers, right? At the beginning of last century, they were the one flying that plane. Nobody else was. Okay, it took us as humanity, quite a few number of years before the ones developing the planes were not the only user of the plane. So artificial intelligence is kind of the same thing, continuing the analogy. At the beginning, it was just, the data scientists, the engineer, the physicists that actually developed those models that were actually able to use it. Now we're in a phase in which company like ours and other players around are actually developing technology that it's able to be used by non necessarily super technical people. So that's why it's a really transitioning phase into what I personally believe to be the assisted decision-making era. So we come from what I like to call the data-driven decision-making era. A lot of statistics, a lot of data, and it's your job as human to make all the decision yourself. The assisted decision-making era is an era in which these computers are able to read through these statistics and suggest a decision, a positioning, or something. Then, of course, you can interact with that and have your own opinion, but still, it's a major leap ahead in decision-making process in general. So this is, I think, where we stand now.
Awesome. So let's get through the deep end immediately, talking about investing and investing as a tech challenge in particular. So I've been reading a little bit of your material, and I was fascinated by two concepts. One, that investing is defined as a tech challenge, and it's AI driven. So maybe we can focus a moment about these two components.
So absolutely. I mean, the first thing is that to invest well, whether it's VC, private equity, public markets, you need to have an information advantage, right? If we all have the same information, we're out of the game together. So the financial market has been becoming so complicated, and the complexity is actually increasing because of two factors. One is internet, who has completely democratized the access to information. So everybody has access to the same information at the same time. Therefore, finding an edge there has become tougher and tougher. That's one thing. Second thing is globalization. Companies, economies, countries, they're all becoming more connected one to another. Now, the world that we're living on now is just the last example of this, right? And we can all see how many ties the economic system has. So understanding all those ties is becoming way more complex. Back in the day, it was much easier to understand how a system, a company was operating. Now, it's so complicated. Amazon, is it an American company? We will probably say yes immediately. But then if you think about it, okay, not just in terms of how many revenues they make in the US, but in general, how they're structured, what type of counterparty they have throughout the world, it's much more than that. So catching all this dynamic, it really is becoming a technology challenge, right? To have the right technology to be able to capture this dynamic properly. So yeah, that's why we believe that having a technological edge is crucial. We have to remember, though, going to the second point, that AI is not this AI-driven concept. I want to also demystify a little bit. We're just climbing on the shoulder of giants that came before us, right? So we are putting, what I like to say is that we're putting adaptability on top of econometrics. Econometric is the math that is used to develop financial modeling in general, but it's very static, right? It's developed in one point by somebody who needs to have all the knowledge possible to create the model able to capture everything. We all know how tough is that, right? So that's very static and very backward looking. Having a system that uses the same math, the same econometric, but it's actually able to make it a little bit more adaptable and able to adjust as time passes by and to evolve, that really is the future, right? So, but marginally speaking, it's not that we believe that everything that came before us is wrong. It's absolutely right. So all the literature that has been right, all the papers, all the models that are out there being used, they're all really valuable. What we are doing is just, as every innovation is, putting a marginal new thing on top, and that usually is what is disrupting. Very rarely disruption happens because you do something completely new. I mean, think about SpaceX, right? I mean, we all remember the space shuttle. That was reusable as well, right? But it was slightly more complicated, not as efficient, and so on and so forth. It's not completely invented a new way to land rockets. Yes, that's a new way to land them, but still the concept was there for many, many years. So it's kind of the same thing, just applied to the world of investing.
So going back to the idea of hedge, I think that in investing, hedge comes from different sources, and two of that sources can be either signals or sort of fixing some biases. I believe AI can have both an interesting role in both fields, being it like finding the right signals, the right pattern to allocate or to position a certain amount of capital, but at the same time maybe fixing some human biases that can jeopardize the investment process. What is your take on that? Do you think that it's more toward sort of the data, the high capability of data processing that can give you better signal system for humans to actually be better as investors, or it's more, the cold-blooded part of the robot that is doing the investment according to rules with zero bias?
As human, in general, we would like to see this artificial intelligence able to do things like Matrix, okay? In reality, we have to understand what investing is. Investing is taking risk, okay? It's taking risk. What you do as a VC, as a private equity firm, as a company, as a fund that invests in public markets, where if you buy a house, you're taking a risk, okay? So we should not look at investing as just catching opportunity, but really investing is getting risk and taking this risk with you. So what artificial intelligence is able to do is actually to find, of course, signal hidden in the noise, but most of the time these signals, they're like very, very feeble, right? They're very, very subtle. They're not like super obvious. But the way it's interesting is that because there are many spread around, you can combine them as well, considering risk, and that's become an edge. That what becomes an edge that can create alpha, if you will. On the other side, though, how you do it is so important, because investing is risk, and because we as humans live of emotion. Okay, think about when the war happened just now, COVID, all these situations, they put a lot of stress, right? So being able to analyze all of this without emotions and with less bias, we should be saying less bias than completely unbiased, because biases are all over the place, but at least less bias, and especially less emotionally biased. It's a very, very interesting way to provide an investing idea, an investing portfolio, an investing signal effectively. So that's why it's so relevant. And if you think about it, what we're living not just now, in the fintech space or in technology in general, with especially the Nasdaq going down so badly, and a lot of tech companies suddenly being under a lot of pressure, it's one of those moments, and you have to ask yourself: are we living emotion now, or is it structurally different, the market? All of these, I mean, we're not in a position to say that the human is always wrong or the technology is always right or something like that. We do believe that man plus machine, so having two concrete and valuable inputs, are actually the best way forward. So that's why having the two things combined is actually useful. You have to remember one thing: the machine delivers, the human surprises. Okay, that's why combining them together usually lets you achieve great things.
Interesting.
Yeah, that's quite interesting. I mean, I've seen this concept applied sometimes in VC, specifically in adopting AI in VC with the term centaurs. So the mythical beast, half man and half horse, when the combination of the AI and person creates something better, maybe.
Yeah.
But this is fascinating hearing this in this way. Nice.
Yeah, but at the end of the day, we've done it with everything. Like, think about this. This is created by robots, most of it, designed by human, with some part that still are done manually. It's similar. Very, very rarely we have a technology that completely does everything by itself. We do need to combine the two things together, and the key of the game often is how you combine the two things. And that's why also a lot of the work that we do with our clients is also doing that very, very well.
Awesome. Let's quickly maybe go through just to dig a little bit deeper on the major trends where AI has been applied. So I'm just throwing to you like different zones where AIs have been playing a major role: portfolio construction, fraud detection, risk modeling, bias reduction, and the list goes on. So give me a feel on where you see the market going and what you think AI has been validated mostly. In which is there specific areas where AI has been like majorly successful in delivering results?
This is in financial services across, or just in investment industry?
I would focus on with the investment industry. Yeah.
So within the investment industry, I mean, the first problem that got tackled by AI are the operational one, right? So this is more like towards wealth management, but it's like making sure that the client is the right one, that is well profiled, and the operational part of interacting with them is super smooth. That's the easy one, because it's more like it's purely operational, right? So when we have to move in investing into truly the world of investing, we're actually moving into making a decision. Making a decision, has many problems associated with that. So the areas in which AI is currently being used a lot, and it's growing massively, it's definitely portfolio construction. Mm-hmm. It's tactical and strategic asset allocation. When done properly, it's been proven to be very useful. In general, it's creating basket of securities, portfolios, not really picking stocks. Picking stocks meaning like individually picking this one and that one and few others, right? That's where it's very not so interesting, the application. But in portfolio construction, where you really have to combine many elements together, and combining those risks that I was mentioning before, right? So all those hidden signal and risk, and you combine them together well, that's where you actually have very good numbers, and things are going very well. So that's also where most of the industry is focusing right now. There are other things such as making sure that the order are perfectly placed and all of that, but it's a minority, I think, to the overall application spectrum.
Got it. All right, let's start talking about MDOTM journeys from the beginning. So how did it all start?
So like most startups, it started to solve a very personal problem. As I said, was coming from finance. Honestly, I had always the idea that I was working with limited information, the top of the iceberg when it came down to making an investment decision. I felt like it was I lucky? For sure, when things were not going my direction, I was unlucky. Never bad, always unlucky, right? So you start thinking. I was thinking to myself, and I was like, I want to develop something to make a more informative decision, right? So to get to really work with the depth of data. Okay, so myself coming from econometrics as well, I had the tools, the know-how to develop models and so on and so forth. But I knew that wasn't enough, so I called this longtime friend of mine, Federico. And we started really in, the two of us just developing the first algorithm. Then we moved to London. We moved to London because, in fact, this is Italian startup, but we're very much London-based as a company. So we moved there. Why did we move there? Because we knew nobody. So we were like, let's go where the biggest market is. And we started knocking door to door. It took us a long time to find the first client, 8 months or something. We had a very clear idea, though. We didn't want to have friends and family or some rich people playing with our algorithm. We wanted to have to be proven on the ground. So we went for future investors, so asset manager, insurance company, pension funds. We pretend we're good at doing algorithm. Let's go and talk to them. If they like it, it's valuable. Still, we had a rough idea on how the market was structured, because it's a pretty complicated market. So it took us 8 months. We found the first client who believed in us, put €1 million running on the models. And that €1 million became 5, 10, 20, because we were able to both grow with the client and find new ones. We got to 30, and at the end of 2017, we got selected by Google for Entrepreneurs to be accelerated by them in Silicon Valley. And that was a massive operation, a massive chance for us to really take a moment off of starting a business. I always say that starting a business is like a rush. You have to do stuff all the time, right? And you try to think, and you're thinking, we're strategically thinking, but you're doing a lot of stuff. So being away from business for 1 month with them, it was a great exercise to really look at the opportunity on the market from a more, let's say, detached way. We cleared our vision better, and we came back with a very strong idea. Let's raise capital and really attack the market to do two things: managing money with a sub-advisory business model. I'll go into detail on what that is in a second. And then developing a technology that, as I said, with the Wright brothers, could be used by somebody who's not a super tech. So we came back in 2018.
So wait, let me stop you there, because I would love to make people, the listener, feel the gap between your first product with your first client, and then we will move talking about what's going on right now, just to see the huge gap that probably you guys went through. So what was that first product? I'm really curious.
So the interesting thing is that, so this is finance. Things are supposed to work always, okay? So the first product, the first algorithm is still running and works very, very, very well, actually. That's good, because otherwise we would not be in a good position. But it was very good to a certain extent. It was also very mature. Let me explain you why. It was almost like an hedge fund product. We were selecting maximum 20 stocks, on average 50% invested, so on average like 12, 13 stocks in the portfolio, from 3 geographic areas: Japan, US, and UK. 50%. So therefore, the portfolio was 50% cash, 50% invested on average. Okay, trading almost every day. Very, very high conviction, meaning that you're taking big bets. So it was really good, because it set us apart, and it still is running and works very well, and it's performing well. But the thing is, it's not sellable. Who needs that? Maybe an hedge fund, but we should have been an hedge fund ourselves. We knew that scaling up an hedge fund, it's complicated. It's very relationship based. There's not a massive opportunity to attack the market there. It's a shrinking market to a certain extent, and therefore it was good because it sets us apart, but completely different to what we did now. So that experience in Google was really sitting back and thinking, okay, we're good at this, or we think we're good at this. We have a strong vision. Where do we want to make sure that the technology and the investment theory that goes along with it, it's going to grow? And we kind of ditched the more aggressive approach into making investment decision to a more like asset allocation construction, portfolio construction, tactical and strategic inputs for the investment committees. How do you make a financial product that's actually distributed, sellable by third parties? And all of that actually have a much more attractive for the market and for the institutional investor. And in fact, with that vision, we went from 30 million euros, okay, that we had at the end of 2017. Of course, in 2018, at the end of 2018, we raised 2 million euro in funding, and then we raised an additional 6.2 5 months ago. But in like 3 years, we went from 30 million euros to €1 billion that we have now in sub-advisory. This is an agreement. So let's understand what we do. We do two things. On one side, we are a sub-advisor. It's called sub-advisory. The business model is a regulated activity. It means that you're working with either an asset gatherer or an asset owner, meaning like an asset owner is somebody like a pension fund, an insurance company, a family office, somebody that owns asset. An asset gatherer is a private bank, wealth manager, etc. So if it's an asset gatherer, we do products with them, financial products, fund, discretionary mandates, certificates, okay, that we sub-advise, means that they're using our portfolio construction to build all the products, and so an asset owner, we actually manage it for them, always with this portfolio advisory agreement, roughly $1 billion. On the other side, we have a technology that's used today to advise investment decision making for roughly 30 billion euros. Okay, and this is where the technology is used independently from us. So in the first place, we're much closer to the investment process. On the other side, we're a little bit further away, and they're using our technology to do it.
So
okay? So we grew from 30 to 1 billion, which is a lot, and also completely launching this new side of the business. So just because we were able to change from and understanding what the market really wanted.
So instead of digging for gold, you're building shovels, basically, and in a sense.
In a sense, it's both. It's on one side where we manage money, it's digging for gold ourselves. On the other side is also providing the technology to help others do it themselves. So it's what all major companies do. If you think about BlackRock, okay, BlackRock is the largest player in asset management. Okay, they have roughly 10 trillion euro that they manage. Okay, it's a lot of money. Still, 40% of their revenues, 45 actually, over the next 2 years, is projected to come through Aladdin, a risk management tool that they own, and it's going to provide almost half of the revenues. It's just a technological tool. It's also very credible. They're a big asset manager, the biggest on the planet, and at the same time, they have a cool technology to risk manage for themselves. Why not give it to third parties? This is similar. We manage money ourselves. We can do like more creative stuff, etc. But still, we have a very, very good technology. And investors, big names, were like, we would like to have access to that and integrate it in our process. Can we do that? Yes. And that's how it all started.
Fantastic. And okay, classic VC question: what separates you from the competition in a certain sense? Yeah, sorry, it's a bit uncomfortable.
Yeah, no, but
a fun one to make always.
Yeah, it's not uncomfortable actually, because we did agree to become the European leader. There are not many big companies. This is a very uncharted territory. This is deep tech for real. Okay, so it's a lot of R&D. The teams are just now starting to grow, so we're among the biggest in the world. What set us apart today, apart from being quite large, I think that we really combined very, very well two elements: finance and technology. It's not all tech, it's not all finance. It's really that combination. So we have a strong academic and professional experience on how market works and how financial dynamic works and how the system as a system in terms of supply and demand of products, supply and demand of investment idea, and so on and so forth actually works, and how the financial market works themselves, and at the same time of technology. Combining these two elements has proven to be very successful, and all our efforts over the last 6 years that we launched the business has been towards R&D, developing the know-how. In fact, where as a company, we also know where we need to grow the most. It's where on the more like digital part, let's say the tool you interact with, that's where we're now growing and investing a lot of money. But up until now, we put all our effort really into trying to understand the dynamic at the very core. In fact, we also founded a lab, which is called MDOTM Lab, which is a research center with 5 universities. The last one who joined is the Gothenburg University in Sweden, where we actually carry out base research projects. So we like to look at ourselves as a pharmaceutical company, okay, in which you have base research, which is where when you wander into the field of unknown, okay, like you want to look for new ideas. Most of them are like shitty, honestly, but some of them are good or potentially good. So that's in the lab, okay. We have now currently 48 PhD student, thesis professor doing R&D project with us. When we find something that potentially could be interesting, that's when we bring it internally. Internally, we have 3 teams of technology. One is R&D, led by my co-founder. They do applied research. That's where actually you're supposed to bring something out, get something out of the R&D that you've conducted. Then we have mission control. That is a team, just like a NASA, the team that looks at the rocket launching and landing itself. Still, there are a lot of engineers making sure that everything runs smoothly. That's mission control for us. They do risk management and make sure that the model works. And then finally, engineering, which is software engineering. Actually, they create the platform, the technology internally and externally to make sure.
Awesome.
Cool.
It's a lot. It's definitely a lot, and I have a billion questions. But let's go straight to the heart of your business, which is Alice. So let's talk about Alice.
So Alice, which stands for Adaptive Learning in Complex Environment, what it is. People have the perception that it's just one brain that does it all. No, it's just a series of algorithms all connected one to another, much more complicated than that. Why do we do that? And then how does it work? We did that because If you have a system that is just one as a whole, it's really, really tough to understand what is going on within itself, right? Whereas if you have a very, let's say, almost like a chain, a very split up processes where an input becomes an output, that output becomes an input on something else, and so on and so forth, we can really track it down. So it's much more easy to understand when things are going, not going, or are working or not working. And also it's really easy to explain what's going on and why the model is deciding something, because you can just track where the information changed. So that's how the technology works in general. In terms of like the pure technical stuff, just so we have, all the same, we're all on the same page on this. What is AI? So we consider AI, which is a concept. To me, it's just a marketing terminology, honestly. But let's put it this way: if an equation is y equals to something, okay, maybe a quant model could be, or econometric model could be beta times the first variable plus beta times the second variable, and so on and so forth. That's an equation, right? When that equation has elements within it that are auto-determined, it becomes, by the standard, machine learning. Mm-hmm. By this extent, for who's familiar with financial modeling, a GARCH is machine learning. I don't know if that's the case, but nonetheless, let's put it that way. When you combine different machine learning techniques, it becomes AI. So AI is pretty different than probably what people think out there it is. Nonetheless, it's very powerful because it is combined on all these different elements. It can really leverage the power of data. As for example, what type of data we use? We use three baskets of data. Macro data, which is like all those data that help us to have that economic framework that's so important, okay, like at the very top. And then we go down into almost two legs. On one side, we look at fundamental data. Okay, this is really, they're slower to adapt, but they are really good to understand what type of risk and opportunity your portfolio, your investment is bearing. And on the other side, market data. Market data is to understand the micro and macro structure of the market. So altogether, we look at a lot of data, but combined, they actually are really good to create that cold picture of the market that Giacomo, you were saying at the very beginning. You were saying it's just cold. It is pretty cold, right? There's no really emotion within the data that we look at. That's why it's so valuable. Then how it actually works in depth, it's quite complicated. We could talk for hours, but in general, the idea is this. To understand how at least our analyst works, we have to understand how we make a decision as human. We make a decision using two things. One is experience. The other one is data evaluation, evaluating the status quo. Everything we do in life is that. So when you're thinking about, buying a house, for example, yourself, you're thinking experience. You're thinking, that buying a house tend to be quite a safe investment. Okay, and you know that because of the past. You know that because your parents did it, because your friends, etc., etc., etc. You know that you always have something that you can touch, and that element of looking at your house also gives a solidity to the perception investment. You could go sleep in there. Those are all elements that has nothing to do with the house you're thinking about buying. That has to do with other houses you've seen in the past, etc., etc. Right? When it comes down to evaluating the status quo, you try to think what type of house it is, who are the neighbors, where it's located, is it in a nice neighborhood, what's the expected potential. So it's always experience and evaluating the status quo. We kind of do the same thing. We do experience with a technology which is called non-chronological learning, which is basically a technology that mimics the experience part, where we refer to stuff in the past, but rather than referring to few elements, we refer to a lot of points, a lot of data points, of course. And the other one, we do it with a different thing, which is called regime analysis. We want to understand what type of regime of risk we're living in now. And by combining the two elements together, we come up with a decision, basically.
That's awesome.
Interesting. If I may, Jack, all of this begs the question. In the last 10 years, markets have always been going up, basically. So all of the players that have been working the last 10 years have never seen a real market downturn. How are you seeing this ecosystem, this infrastructure reacting to what's going on right now?
So it's it was nice. Honestly, it would have been better to launch the business in another moment. I have to say that I don't know, I like to look at the positive stuff. I mean, as an entrepreneur, if you're not positive, it's a tough job to be doing. But we're pretty lucky because we launched the business in 2015. Okay, early on, this is something that got almost unpicked, but it got picked by the financial industry. We went through the end of 2015, beginning of 2016, the Asian crisis. There was a crisis in Asia in the financial market. So that was the first one. Then we went through Brexit in 2016. Then we went through the election of Donald Trump. Yes, the market went up, but still way different market condition. And you have to imagine that models react in market condition. That was a different market condition. Then we saw 2018, the market went down, etc. Then rebounds, crazy rebound in 2019, then COVID, and now a war. I mean, yes, generally they went kind of up, but it's been we saw quite a lot. So we're lucky that we, having lived through that, when we talk with clients and within ourselves, with the team, we have a lot of experience, and this is stuff that we've lived on our shoulders and on our algorithm. So that's the first thing. Second thing is, the beauty about finance and the data we work with is that it's very objective. So even though you've not lived through everything, okay, and people keep referring to 2008. 2008 was a bad moment for sure, but believe me, because it was like all connected, but believe me, the early 2000, that was a devastating moment. For 2 years, we got markets going down, a lot of uncertainty. So it's not just the 2008 moment that people think of. They should be thinking also other moments, such as the 1970s, 80s. So finance has the beauty that being very, very objective, if you do a lot of work in building your data set that hasn't got what's called survivorship bias, so it's very pure, very, very well constructed. It's you can actually use all that element to create a very good experience to interpret today, tomorrow, and what might happen in the future.
That's awesome. Super awesome. I would love to talk about some use cases of Alice and maybe some examples. So we've been like kind of digging through like the theory here, which we love. Me and Nick, we absolutely are delighted by that. But to give like a practical application of maybe a few use cases that you guys are developing with clients, that would be a very good perspective.
Yeah, for example, if you can talk about the one that started all of these, the article about Banca Sella, but
absolutely.
Example.
No, I mean, we have different agreement and with different counterparties. I'll tell you two type of application. One is products. If you're a bank, you're an asset manager, you want to launch a new product, that it's that we all know that in general you need to diversify to be better off in life in general. Don't put all your eggs in one basket. That's what we learned since we're kids, right? So it's always the case. AI, given that looks at the world in a different way, it's a good way to both have a different opinion on the market, but also have a different product. So if you're a bank, you're an asset manager, or a family office or an insurance company that either has money or manages money for their clients, building a product with our technology allows you to create a product that it's different, okay, moves in a different way, and therefore diversified. So an application is doing financial product with that. Okay, that's one. The other application, which I think is very, very interesting, and it's the one that you picked it up, for example, with Sella SGR and the Gruppo Sella in general, it's where we support the investment process. That's really interesting to me because it's combining human and technology even more. Because on one side is really just straightforward applying it. It works well, it diversifies the portfolio. But this one actually creates that, combination of man plus technology, which is what made us great as a species. We're here because we were able to use technology, because we think technology is just internet and computers. It's not. Technology, it's a lot of stuff. It's being able to develop, to carve a stone, to become a point of an arrow, for example, okay, and to hunt with it. That's technology. It's more rudimental, but still is technology. So combining the two elements is interesting. What we do with, for example, Sella or other counterparty, just like that, we support them at their investment committee, okay, on how they come up with their strategic and tactical asset allocation. This happens by doing two things: by understanding very, very well how their process works, and integrating and customizing and integrating the output of Alice within their investment process. This is one of the hidden benefit of artificial intelligence, which is the fact that it can be customized a lot. Okay, so we have to understand what a nonlinear problem is. We grew up thinking that big problems. Sorry, I'm taking time, but I don't know if this is interesting.
Go ahead.
You know, we grew up thinking that complicated problems have one right solution. That's just wrong. I don't know if you remember the days of math at school. You solve your equation and there are maybe 7 solutions or infinite solutions for this problem, right? There are more than one solution. To a complex problem, that's usually the case. Finance is the best example. What is the right answer to finance? Probably, if you could see the future, it would be knowing what the best asset class is, the best performing asset classes will be tomorrow, and put 100% of your money on it. And at this point, leverage it, as much as the market allows you to do with volume, right? That's the only right answer. But because that's clearly impossible, nobody can really see the future. You need to think about a portfolio. Talk about a portfolio, selection, a basket. The moment you talk about a basket, you have an objective. You have a time horizon, a risk return expectation, a base currency. What's your base currency? Maybe you're dollar based, you're sterling based, you're yen based, or euro based. It changes completely. Where you're located in terms of geographies, what type of asset class you work with. And so therefore, immediately there are more than one right solution. So the benefit that artificial intelligence, not being a trading algorithm, but like a broad investment methodology, can be really applied to try to solve this problem in different ways. So what we do is we work with the team and we customize our technology to be integrated, and then we support their strategic and tactical asset allocation. And then what they do is at an investment committee, basically it's almost like the lighthouse to guide the overall organization to then either it gets converted into advisory portfolio, their own money, their positioning, and so on and so forth.
But is it more of a benchmark sort of methodology where, the investment team does one job, Alice outputs something else, given the information that are fed through the algorithms, and then you guys compare notes to see what has been happening? Or it's a different, like how exactly does it enter the investment selection process?
So yes and no, meaning that because let's say the thing you described is much more like research. Mm-hmm. What is Alice seeing, and what are the human thinking, and how we can go and then let's just exchange notes. That we do that sometimes. Okay, it's almost like we call it unbiased market radar, which is what we think it's going on in the market. But the moment you start combining the two elements, that's what actually the output ultimately changes itself. Because I'll make a quick example. If you are a VC investor, okay, and you can invest, and you're thinking about setting up a VC fund, okay, you're thinking about investing in Italy. Then when you started to invest, there's a big crisis in Italy. You already raised the capital, and you're looking at your teams and your partners, and you're like, there's no point in investing in Italy. Let's invest in Spain. Similar to Italy, similar dynamics. Let's go there, okay? You would have never thought about Spain, but that crisis changed it and opened up a new opportunity that you were not thinking of. AI can do that. AI can be pointed up in a way that you were not expecting. So if suddenly the human thinks something and wants to implement that, it's not that AI tries to force an optimal solution. Maybe it opens up a new opportunity that was not thinking itself, like we do as human. And that's why it's so interesting. And that's where the integration becomes even more closer. And how do we do that? By basically letting them interact with how the market is perceived and what's the scenario associated, the probability of scenario of certain dynamic. And by changing that, it actually opens up to different portfolios that you would never have thought without this joint process. Does it make sense? It's quite philosophical.
I love it.
Investing,
totally love it.
Honestly, it's a little bit philosophical at the very core.
Okay, it's not about receiving answers. It's about opening up more questions and more opportunities.
Exactly.
Okay.
Exactly. And
Yes.
and this is you can only do that if you have this is typical of nonlinear problems, right? Because there's another right solution that you would not have thought. And the only way you can get to that one is if you change somehow the input of that. Otherwise, you're just forcing the two things together and you end up where you are, basically.
So it's almost like a tool for lateral thinking. So AI, it's really a tool for thinking laterally, where maybe we kind of are focused on a certain element and then AI allows you to broaden the perspective.
Absolutely. That's why we're bought. We're bought to enlarge the spectrum of and how we look at things in the first place, which is investing. I always say to the VC investor in general, it's the same job. When you pick a company, what do? You're picking a sector, you're thinking it's going to be a winner, you're thinking about the dynamics, the valuation in the market, who's moving in that field, and you're trying to find new ideas. It's very, very similar.
Yeah.
We just do that on the public market, and but the underlying dynamics are almost the same.
So the human element is going to always be there. We don't foresee a future where AI is going to take over the world and humans are going to be useless in the investment process. What's your feel on that?
I very, very doubt that's going to be the case. Honestly, because we actually do AI, I know where AI stands in general. And even though it's super powerful and we see the benefit, the application, and we also know one thing, that it's improving fast and quickly. And because it's a technology, tomorrow it's better than today. Not because it's learning better, not really that, because technology is becoming faster, because data is becoming more available, because the know-how on how to do stuff is increasing. So yes, it's increasing. It's going to be able to do always more things, always better, more precise. But to think that this now becomes almost like Matrix once again, maybe one day in the future, but believe me, we're very, very far off that. It's gonna be, if it happens, it's gonna be, I don't even know when, but way down the line. It's not anytime soon.
Awesome.
But now it's really applicable on a lot of things that actually are very practical. So
when I think about AI, I've been reading a little bit of different literature, and there is a big distinction between defining the problems and solving the problem. AI is really, really good at solving, and it's not really a question whether AI is going to be better than human at solving, but the definition of problem, that's still the part that's it's hugely human still.
Absolutely, always. The machine delivers, the human surprises. Always, and that's always the case, right? But at the end of the day, AI, it's just the same thing as robotics applied to more complex problems. Okay, we were really good at tidying knots, for example, or to build a sail, or to build a car ourselves. But the technology came along and actually was not getting tired, doing all the time at the same thing. Sometimes, it got stuck, but that, with a very precision, and that increased. A lot of the application of AI in decision making is similar. So there are decisions that you need to take all the time and are based on evaluating many things together. That's where AI obviously is better. But that's a part of making decisions. There are a lot of parts that you need to think on your thing, that think differently, etc., etc. And that's where the human actually has an advantage. So that's why man plus machine, it's really the future. And but that's also why not having AI is wrong, missing out opportunities as well. So it's a less boring than what people would like to think that it's
super exciting actually.
But in reality, for those who are actually doing it, probably more exciting.
Okay.
I find it interesting what you just said, that AI is becoming something that you needed to play the game, not anymore just a simple strategic advantage. You want to play, then you need to add AI. That's interesting.
You need it,
that's really interesting.
Otherwise, because at the end of the day, how much of your market are you really looking at? So a big portion of building a portfolio is just think about correlation. How many numbers can you remember on the top of your head that you watched yesterday? None of them. We forget stuff as human, right? The machine doesn't. It looks through all the possible correlation that are out there in the market, combines them together. How do you do that? And that's big part of investing. It's not just picking up stuff. It's like combining them together. So you really need it. Nowadays, it's almost becoming a standard, and and will be more and more going forward. Absolutely.
Interesting. So that's a question I like to ask. What's a question that people don't ask you enough about your job, about your company?
A question I don't get asked enough.
But you think it's
a
important.
lot of questions, believe me, between investors, and I get asked a lot of questions. No, maybe a question that I don't get asked enough is what do we look in people that we hire them?
Okay.
This is like baffles me, because I would like to have, to talk more about that. At the end of the day, once again, it's technology, it's artificial intelligence, it's about people. It's about people, making them work together. It's a team. More honestly, more than traditional investing. Because traditional investing, there's a lot of the sense of ego. I'm the one making the decision. I'm the one calling the shots, etc. This is a team effort, right? So what do we look in people? For example, we look in people that we don't very much like, don't want to offend anyone here, and there are absolutely exceptions, but we don't really like too much like math and people with that background. It's too theoretical. It's not very much applied. We like physicists and engineers. Why? Because engineers want to do stuff, right? You need to untie that bolt, and they just go there and try to open it up. And the physicist asks himself, why? Why should they do it? They want to understand how the world works, right? So combining those two elements.
Why is there a bolt there, actually?
Why is there a bolt there?
That's awesome. That's awesome. That's more philosophical. I mean, I have a background in philosophy. I feel like, called in cause. That's also a philosophy guy, like kind of question.
And also most of the time, you see these quant teams inside of also like big organizations that are always a little bit left on the side. It's pretty sad, but they are supposed to both develop the model and monitoring the model. Don't let the team do that, because know the skills of the people you're hiring. People who are able to develop the technology, build the models, they cannot be bothered into making sure that everything runs smoothly every day. That for them is just not important. They know it's important, that they just don't want to do it. So you need to create a structure, hire the right people to actually do the right job. Okay, you want to have somebody playing as a striker, you need a striker. A defenseman is a defenseman. Two different characters, two different animals. Okay, this is the same thing. And I think that people don't ask me this enough. They just think, we hire a lot of data scientists, engineers, physicists, etc. There's a lot of like really constructing the team behind the curtain that I don't think it gets perceived enough, because there's a lot of effort as well into thinking how to make sure that they work well together.
That's awesome. All right, we're getting to the conclusion. Let's have just a little couple more questions. What is the toughest challenge right now for MDOTM?
I mean, we're a scaling up business, right? We should be about 80 in the next year. We're hiring a lot of people. Yesterday, 5 people started, joined the business, and 2 will start next week. So it's that exciting scale up phase. I guess that the toughest, side of this is, keeping that startup mentality throughout the process, making sure that the culture is the same. Okay, we have a very positive culture as a company. Otherwise, you guys coming from the sea, that we wouldn't be here probably. How do we keep it going forward? Okay, at the same time, because we're growing bigger, the problem become more complicated, and it's also a structured business. We're ready, because this is like, we work with big banks, big, investors and clients, very structured as a team. So keeping that startup mentality and the same culture throughout the day, probably it's going to be the biggest challenge. It is still, going forward. I think but it's not just us. I mean, I'm just probably saying the obvious here, but awesome. Anyone who's scaling up a business has the same problem.
Right. So give us 3 predictions for the future of AI and investing, like the 3 future trends that maybe in the next 5 to 10 years, we're going to see like moving hard. What's your feel?
I lost you.
We missed the question.
You missed the question. You went away the audio.
So yeah, let's end up by making predictions. So what are the 3 trends, 3 new elements that are going to happen in AI and investing that are going to, surprise kind of everyone? What's your take?
So my take is that it's going to be for sure the standard tool to optimize a portfolio. honestly, I would like be surprised if that's not the case. It's gonna be more and more that the investment world used to be fundamental, like more traditional approach, and then quant approach, completely separate, like moving on two separate, like parallel lines, never touching themselves. Also a little bit of competition between the two of them. I think that this is gonna all collide into one thing, and AI is gonna allow to do that. Okay, so second prediction is, I think we're gonna enter fully into a quantamental world where even the most fundamental analyst will use that technology in some shape or form to make decision. And then finally, that it's going to change completely the probably the third one, just because you asked me three and I need to come up with a third one.
Yeah, you have to.
It's that it's going to change the perception on the time horizon, on when the human steps in and when the machine steps is always running. So a lot of risk now is done autonomously, but it's still done a lot by human. I think that because AI it's always awake and always can provide signal, etc., it's going to be much more deeper in every portfolio, and so therefore it will leave the human a lot of like quick decision to be made upon things that maybe are just outlier. What I mean by this is that what I see a true application of AI that is not yet happening, but it will in the future, is that every portfolio will have some sort of like risk dynamics. Maybe it's not necessarily able to interpret that risk, but it's very quick at determining if there's an outlier, something not supposed to happen, to be sent up to a human to make that quick decision. That's where you need to surprise, where you need to make it up. So these are three, my prediction of what could happen in AI in the future.